Stop waiting for the future. It's already here. And it's brutally efficient. We're not here to predict technological change, but to document the active, measurable financial purge that is already rendering trillions of dollars in market capitalization worthless. The obsolescence is not coming, it's happening now. The end is not near. For 10 foundational industries, the end has begun. This is a live, real time market decay you can already track. The question is not if they'll fail, but how fast and how much wealth will be created by their successors. For the strategic investor, this isn't a forecast. It's a sell signal for the past and a definitive buy signal for the technology that is actively taking over. The countdown to 2030 is simply the expiration date. The death of physical cash is not a prediction. It is a documented multi-year trend. We are already witnessing banks dramatically cutting ATM networks and retailers refusing to accept cash to cut costs and theft risk. This active decline is being fueled by the massive ongoing adoption of digital wallets, the implementation of biometric payment systems in physical retail, and the critical development phase of sovereign-backed central bank digital currencies, CBDCs, across major economies. The financial reality is that companies relying on cash handling infrastructure, from armored transport firms to ATM hardware manufacturers, are already posting declining asset utilization and increasing write-downs. This is measurable decay. Every day, the efficiency of digital transactions steals market share from the costly logistics of paper money. The focus for urgent investment is on the systems already capturing this transactional volume. This means high throughput digital payment rails, the companies offering secure institutional custody for digital assets, and the innovators making digital identity the key to commerce. The wealth transfer is already in progress. Imagine financial institutions that barely touch paper, just code, data, and instantaneously verify transactions. Are you investing in the iron wheels of the past or the high-speed code of tomorrow? Traditional cable and satellite TV is not just shrinking. It is in an undeniable, accelerating revenue collapse. This isn't theoretical. Cord-cutting metrics are reported every quarter, showing millions of subscribers actively fleeing bundled packages for cheaper on-demand streaming. The failure of linear TV is driven by its terrible cost-to-content ratio and its rigid scheduling. Consumers have already voted with their wallets for agency and personalization. The financial damage is visible in the debt-heavy balance sheets of legacy media conglomerates. Their primary assets, national coaxial grids and regional exclusivity contracts, are proving to be financial anchors, requiring expensive maintenance while simultaneously delivering dwindling returns. Their distribution model is already a liability. The immediate opportunity lies in the media supply chain that is already operational. This means investing in companies that offer global, scalable, direct-to-consumer streaming technology, those leveraging AI to personalize content discovery, which boosts retention, and firms dominating the high-yield programmatic advertising on streaming platforms. The market has already priced in the decline of the legacy model. Don't be caught holding stocks that are still pretending the Titanic is unsinkable. The password is now a corporate liability, not a security layer. Its inadequacy is already proven by the constant barrage of high-profile data breaches and the immense cost of managing IT password resets. Enterprises are actively deploying the replacements right now. FIDO-certified passkeys are rolling out across major tech platforms, and behavioral biometrics are being integrated into banking and high-security systems for continuous verification. The financial imperative is no longer about preventing a breach, but mitigating the massive regulatory and legal fallout that inevitably follows. Companies that cling to weak, password-centric security are actively building up their future liability in fines and cleanup costs. This risk is already quantifiable on their balance sheets. This makes identity assurance an urgent, multi-trillion-dollar upgrade market. Focus on firms providing enterprise-level zero-trust architectures, developers of the hardware and software for seamless multi-factor authentication, and the providers of decentralized identity (DID) solutions that give users verifiable control. This investment is an essential cost of doing business in the digital economy. The future of security is already being implemented. Invest in the technology that is actively removing the single weakest link in digital commerce. The end of fixed line telephony is a structural event, not a projection. Telecom operators globally are in the long, expensive process of decommissioning copper networks because the cost of maintaining them far exceeds the residual revenue. The market has already transitioned to VoIP, and critically, 5G 6G wireless, which offers superior quality, mobility, and capacity with minimal physical infrastructure. The business case for copper has been dead for years. The financial pain is in the stranded assets, the vast physical copper grids and switching centers that require constant maintenance. Companies that have delayed aggressive decommissioning are seeing their operating costs rise and are losing high-margin enterprise business to pure-play cloud-native communication providers. This is a visible drag on earnings today. The investment opportunity is 100% in the utility of the network. Target mobile carriers actively moving to network virtualization and edge computing. More importantly, invest in the IoT communication platforms, the low-power networks, LPWANs, that are already connecting millions of industrial sensors and logistics assets. The value is migrating from the wire to the software-defined spectrum. Don't buy into the nostalgia of the past. Invest in the infrastructure that is demonstrably scaling right now. The obsolescence of the manual-driven car as a dominant form of urban transport is already manifesting. We are already seeing large-scale autonomous taxi fleets like Waymo and Cruise operating in major US cities, proving the economic and safety case. This isn't just about safety, it's economics. The cost of mobility as a service, or MaaS, an autonomous utilized ride, is rapidly approaching the point where it becomes cheaper than private car ownership, making driving a luxury hobby, not a necessity. The financial crisis is already gripping legacy auto manufacturers. They face the impossible task of shifting massive assembly lines designed for internal combustion engines and human-centric components into facilities for AI-driven EVs. Their traditional product sales are already under pressure, and their existing factory assets are quickly being rendered obsolete industrial liabilities. The investment focus must be on the operational technology driving the autonomous fleets already on the road. This means investing in LiDAR, radar, and advanced sensor fusion technology, high-performance AI compute chips designed specifically for vehicles, and the full-stack software platforms managing these fleets. The value is already shifting from physical assembly to intelligent software and hardware integration. The driver's seat is already seated. Ensure your capital is invested in the new captains of the road.
Please place the item in the bagging area. Scanning complete.
The traditional checkout line is not going to die. It is actively being retired. Retailers are already eliminating cashiers to counter rising labor costs and drive immediate efficiency gains. The technologies replacing this labor, computer vision, RFID-based inventory, and sensor fusion, are operational today, powering cashierless stores and making the transaction instantaneous. The financial motivation is immediate. Every major retailer is desperate to lower their labor cost per sale. Those who delay automation are already losing the price and efficiency war to competitors who have adopted frictionless checkouts. This decline in manual retail jobs is not projected. It is a visible, ongoing reality. The opportunity is a clear automation play. Invest in firms specializing in AI-driven inventory management that minimizes waste, logistics robotics that automate warehouse operations, and the advanced vision systems that facilitate immediate, frictionless payments. These companies are actively delivering demonstrable cost savings to their clients right now. The inefficiency of manual scanning is a liability. Invest in the software that is actively removing friction from billions of transactions. The plastic bank card is actively losing its battle with security and convenience. Its vulnerability to skimming and the sheer cost of constant replacement cycles are driving banks to seek digital alternatives. The shift is already happening. Millions of people already use their smartphones and wearables to pay, bypassing the card entirely. The ultimate phase, tokenized biometric identity like palm or facial scanning, is already being piloted in major retail and airport systems. The financial risk for traditional card issuers is that they are being disintermediated today. As payments become embedded in mobile operating systems and biometric terminals, the plastic card becomes a costly, unnecessary middleman. The true power is shifting to the platforms that control the secure digital tokenization of identity. Invest in the technology is already winning this battle. Firms developing advanced biometric sensor technology, companies specializing in secure element chips that store encryption keys locally, and global fintech payment platforms that have built tokenized, device agnostic transaction services. The goal is to own the security and authorization layer. The wallet is already becoming obsolete. Don't let your portfolio be defined by disposable plastic. The flat, rectangular phone screen is not sufficient for the next generation of computing. The limitations of a handheld 2D slab are actively pushing the industry toward a superior interface. We've officially entered the live development stage of spatial computing. Leading tech giants are pouring billions into creating and releasing advanced AR/VR glasses and mixed reality headsets. The shift from looking at our devices to looking through immersive, digitally enhanced worlds has already begun. The investment is less of a prediction and more of a mandatory rotation into the next compute platform. Invest in AR hardware manufacturers who solve the battery and field of view challenges. Companies building the spatial operating systems, the new software platform, and the firms specializing in the AI content engines that will populate these 3D environments. By 2030, the smartphone will feel like a clunky relic because the immersive spatial interface is already being built. The metal key is a security and logistics failure that real estate developers and property managers are actively replacing today. Its inability to provide data on access or be remotely managed makes it incompatible with modern security and hospitality. The industry is already using smart locks, digital access passes delivered via app, and biometric scanners to provide verifiable, time-stamped, and revocable access. The current financial pressure stems from the push for greater operational efficiency. Industries like real estate, hospitality, and commercial security are cutting costs and minimizing liability by adopting digital systems. Meanwhile, traditional lock manufacturers are rapidly losing market share as smart home and enterprise access solutions dominate the landscape. This is an immediate investment in the Internet of Things, security and access market. Focus on enterprise-grade IoT access control platforms, secure mobile credential management systems for large organizations, and the integrated smart home platforms that control lighting, climate, and access. The key is no longer a piece of metal. It is a secure data packet, and that data packet is already providing valuable operational insight.
Welcome. Your reality is
The
waiting.
basic smartphone is already being pushed to its limits. Its dependence on constant human interaction, tapping and swiping, is driving the industry toward an era of ambient computing. The future is already in testing. Ecosystems of AI driven wearables, glasses, high tech earbuds, and rings that are constantly listening, observing, and anticipating your needs. The AI is actively moving from an app you tap to an invisible assistant that runs your life in the background. The next cycle of wealth is being created by the intelligence layer. The immediate investment areas are the companies creating the generative AI models and the specialized hardware, GPUs or TPUs, that run them. Look for the developers of spatial computing platforms and, most critically, the firms that own the high-quality data pipelines that feed the AI assistants. The winner won't sell a device, it will sell cognition as a service. The era of tapping apps is ending now. The transition to an intelligent digital environment has begun. The financial purge is not a projection, it is a live market event. You must assess your portfolio based on a clear reality. Assets are valued not by their history, but by their adaptability to the relentless technological churn happening today. Where industries collapse, immediate opportunities are generated. The wealth transfer from the slow, physical, and obsolete to the fast, digital, and intelligent is the defining market event of this decade. Do not be the investor holding the asset that is actively decaying. Be the investor funding its demise. Study the active decay. Invest in the revolution. Adapt faster. This is the Zalwora mandate. Zalwora brings you the indispensable insight into the future of technology and wealth. Subscribe, follow, and stay ahead because the purge is underway and the future belongs exclusively to the prepared. Thanks for watching.